What is up, YouTube? This is the Working Investor. Today we're going to talk about this hype ETF that everyone's talking about and crazy about, SVOL, Simplified Volatility Premium ETF. We'll also talk about other alternative investments, which is mortgage-backed securities, and why people are nuts about this, even though I didn't understand, because even though it also dropped, maybe even in larger magnitude than the S&P 500 during the fall, it did zero hedge protection against a market crash initially, right? Because look, you see it dropped 10 to 12%. And then if you go to if you go to SPY, it didn't really protect you on a downfall, right? So you go to the 3 months, go look for August 5th, and you'll see here that S&P 500 dropped. Where are we at? August 5th. Yeah, like 6.89%. So I was so dumbfounded why people are nuts about it if it's not really protecting you and hedging you against the S&P 500. So I actually, by doing deep dive into the fund, looking at the fund, their prospectus, and looking at scouring the web on YouTube videos, and actually came across this video by Passive Income Investor, and he actually interviews the fund manager, so you get really good insight. So there is a section where he talks about why people would want to do this fund, and he says the fund manager discusses that even though this fund, their goal is to return 15% overall return, and they've hit 16 to 17% return in dividend premiums, but their NAV eroded 4% in the recent downturn. So they have 12, 13% total return. So he mentions that the reason why people would want to go for this fund is even though it's correlated with the S&P 500, the VIX is correlated with it, implied volatility, because when things are rock and rolling, going high, it's not as volatile. But when things drop drastically in value, that's when you usually have a spike in volatility. So and when there's a spike in volatility, SVOL would go down. And when there's no spike, and when things are stable as a table, then SVOL stays stable and stays up. So he says that the reason why somebody would want to look into this fund would be that they were looking for an alternative source of passive income through cash flow through their dividends. Because the S&P 500 is based on underlying companies, and underlying companies are based on their earnings, and also how the market values their PE ratio, and so on and so forth. This is based on the VIX, which is implied volatility, spikes and peaks and troughs. So that's another alternative. If you're looking for a little bit of a diversification of different ways, even though it's correlated with S&P 500, it has a diversity because it's a different underlying based on different fundamentals. And then but going through their ETF, you'll see simplified ETFs, their highest assets under management, because SVOL is their second highest assets under management. So their highest assets under management is MTBA. People are the most interested in MTBA, which is basically mortgage-backed security, underlying products. And they're returning, if you look at dividend tracker, they're returning about a 5.86% yield, and their NAV is not eroded. It's actually really preserved, their NAV. So MTBA, Simplify ETF, go to their dividend, and you'll see 5.86% average dividend. They're giving about 1/4, 25 cents dividend per month. It's pretty much consistent, 25 cents every single month. But these are funds that are more to preserve, in my opinion, more to preserve your assets. So it's not really to make you rich. Is just pretty much just to preserve. If you go the past year, they're really you can't really see the chart very well over here, but look at this chart over here. You see that it pretty much preserves your asset. So I look at it like a cash, like the MTBA, whatever it's called. I look at it like a cash position, it's like having high yield savings accounts or treasury products, or you could look into mortgage-backed securities. I would imagine that mortgage-backed securities are the market deems it stable because people would pay all, they may skip on certain bills if they're having a hard time, but their mortgage is something that people try their best not to default on, because that's they're losing the roof, they're losing their home, their shelter. So that's the idea of it. So You can see they opened up inception November 7th at $50.10, and their max drawdown was just a few less than 50 cents below their opening. And right now they're actually up 2.2% NAV appreciation. And even with a crazy August 5th, the market freaked out because of the whole thing with Japan, it still kind of held up pretty well. It didn't drop too much, you know what I mean? So people use it as an alternative asset. So these two vehicles, like I say, they're not there to give you max yield. I look at them like alternative investments if you're trying to round out your portfolio. Right now, depending where you are in your journey, like I'm right now in growth phase. So right now I'm looking for big yields, big returns. And, maybe when I'm more in capital preservation stage, I'll look into more of these other alternative products to have other underlyings just to diversify out. Anyway, that's just my 2 cents on it. I hope you guys enjoyed. This is the Working Investor over and out. If you have any thoughts or interesting hypotheses on these funds, let me know.